It was expected to happen. Most people not in the workforce, businesses shuttered, yo-yo policies, and a rapidly changing economic landscape have all collided to form what will now unfold in 2021. There is an understanding that the Fed has everyone's back. Sadly, this could not be further from the truth. Their policies are actually designed to enrich the chosen few at the expense of everyone else. You came here for the truth, so let me unveil that for you. I've got a lot to cover today. We're going to look at the bankruptcy wave that has begun, show you the statistics surrounding that. I'm going to give you some interesting warnings that have been shared here. We're going to also look at several economic indicators. We're going to see the difference between the stock market and the economy, comparison there, and a few charts. I've got a lot more in here as well if I can get to it. So let's begin right away. This article right here is really descriptive, is very long, and I highly recommend that you check it out. I led with this article specifically because it's so important. If you are looking at the statistics today and you are simply leaving out what's to come, you are going to just ignore reality. Because obviously, if we have these problems of people not being in the workforce, all the businesses shuttered, the businesses that still have to officially go through all the paperwork and who have been open and closed and open and closed throughout this period, and eventually we'll call it quits, that has a longer term effect that may not be showing up yet, but has to at some point. So this article gets into a lot of that, and it's basically talking about the wave of bankruptcies that has begun. They give you a few examples here. I'm not going to cover the examples, but I wanted to get into the data itself. Like I said, there's a lot in here, but I'm just going to touch on the important points that you need to know. It has been nearly a year since the shutdowns began affecting large swaths of the American economy. More businesses are filing for bankruptcy as Chapter 11 filings were up nearly 20% in 2020 compared with the previous year. Data on a subset of businesses, those registered as corporations, show that some sectors are faring much worse than others. And that's pretty clear. I mean, we've been covering that throughout this period. Restaurants, retailers, entertainment companies, real estate firms, oil and gas ventures filing for protection in far greater numbers than in previous years. If we had certain sectors, certain areas that are doing worse than others, that's going to show up in the data. That's pretty clear. And you could see that certain places like New York are being hit harder than areas like Florida, for instance. Bankruptcies filed by entertainment companies in 2020 nearly quadrupled, and filings tripled for oil and gas companies, double for computer and software companies were up 50% or more for restaurant owners, real estate companies, and retailers compared to 2019. Okay, so you could look at the data, it's right there for you, and just see what has been happening. But understand, beneath all of that, number one, you've got employees that were working there and they had to be laid off, they had to be fired throughout this period. There are many more coming, of course. Now, they're not going to show up on the statistics. We already know that. But at least you can understand what this means. If these people are unemployed, they are dependent on the government, and that means they aren't going to have that discretionary spending like they did before. You could see how they manipulate the data and show it as in, oh, the consumer is doing such a fantastic job right now. But just like when they introduced Obamacare and you saw the spike up in GDP, everyone was hailing this as a fantastic report and things are great. But no, because suddenly people had to pay more for healthcare. So that was showing up and it was looking like a great thing for the economy. You can argue it one way or the other, but statistically, you are seeing people with less disposable income as a result of that. That's how they skew the stats, all right? And that's what I try to do, is cut through all of that so you know what's really going on. Economists are predicting strong economic growth this year overall, but the bankruptcy data show that despite $3.7 trillion in federal stimulus spending to combat the recession and another $1.9 trillion being proposed, businesses in certain industries have become particularly vulnerable, and it may take years to recover enough to pay their bills. Others will not recover at all. And I do believe that certain industries are just going to be changed for ever, especially in those areas that have been harder hit. They're not going to open up these retail locations like they did before. I mean, it's just not going to happen. Office space may change radically over the next few years. As a result of all that, you've got the lenders, the landlords, the derivatives. They're all interconnected with this, and we have yet to see even a fraction of the mess that that's all going to create. Here's a quick look in a chart form just showing you the businesses that have been hit hardest, number of bankruptcies in the US in each industry, just giving you an idea. Clearly it has accelerated year over year. Everyone was expecting that, but just to give you a chart form if you want to take a look. You may be familiar with Paul Singer from Elliott, but this right here is actually going back to give you historical context before I show you his new warnings that have come right now in 2021. Previously, back in 2014, he was talking about the actions that the Federal Reserve are taking and how they will be extremely devastating later on. More inflation. They're going to create havoc. They're going to create a massive disparity in between the haves and the have-nots. Everything that we've talked about, he was discussing that in 2014. If you want to read it all, of course, I can't describe it all to you, but essentially that's the summary, okay? If you want it, the link is here. You can either pause it or just go down in the link in the description and it will be there for you. But take a look here. Now, recently, he had this to say. Paul Singer warns of trouble and is eager to say, told you so. Hedge fund titan cites head-smacking craziness in markets. Singer's comments in a January 28th letter to clients has been seen by Bloomberg, and this is what they're putting out here. I'm not going to read the whole thing to you, but I just wanted to highlight a few points. This guy has been very accurate over a long period of time. Doesn't mean he's right all the time, that's for sure. We should be aware of that. Nobody is right all the time. But when you see what he has been warning about, it's very clear and it coincides with what we talk about here on the channel. Quote, we believe that hindsight will show the champion of head-smacking craziness in the American stock market to be the period playing out right now. Of course, we have talked about this before, how we're going to look back in the pages of history and realize this was one heck of a time. I mean, just to see the ups and downs and the complete ignoring of reality. And he's just pointing that out. In his view, the Fed's current iteration of quantitative easing paired with trillions of dollars of stimulus are setting things up for a fall. Rampant inflation, once again, we're seeing this theme. Many people have been discussing this. Will shock policymakers, stock pickers, and bond investors alike. Trouble ahead is signaled by a rare combination of low-quality securities, staggering valuation metrics, over-leveraged capital structures, a scarcity of honest profits, a desperate dearth of understanding evinced by the most active traders, and economic macro prospects that are not as thrilling as the mobs braying bye-bye seem to think, okay? So basically, he's talked about what we're seeing today and how that has really played out up until this point. And of course, at some point, it ends badly. That's just a matter of fact. But we don't know when. Nobody knows when. And so if you're able to be like the almost this very, very small group of people that are able to time these markets, which generally even the best of the best do not do, you can, of course, take your profits at the right time and put your money in somewhere that you believe is safe. Others simply ride the wave. The challenge with riding the wave is something that I'm definitely going to do an entire video about, and then do discuss this often. It's simply the fact that when you ride it, nobody knows what comes up on the other side. What will be there after a period, a long drought, let's say. If you look at the NASDAQ back in 2000, of course, took 14 years to get back to where it was previously. In that period, what's going to happen? What kind of stocks will be around 14 years later? That's a long period of time. And that's one example, of course. And I just wanted to highlight that because people believe that, well, I'll just hold if there's a problem. But that's really not actually a strategy. So anyway, and essentially just talking about the return-free risk as he declares government debt. But I think that it is very important to point out that People have that belief that they're always going to be backstopped by the Fed. But if you just understand the Fed's origins, you would realize it's a completely different scenario. All right, you came here for the charts, I know that, so I'm going to show you several right here really quickly. Inflation is percolating in booming housing sector. You could see the lumber prices as well as home prices, and they've been in lockstep. That's been going on over this period. It's been basically everywhere, been affected by these higher prices, and that, of course, pushes up the new home construction price as a result. There's inflation everywhere you look, except in the statistics that the government shows you. Take a look at this one here. Record, stunning $414 billion inflow to stocks in the past 16 weeks. Never seen anything like this before. Look at that spike. Of course, why? Because the risk is on. That's what people believe right now. These are where the returns are. And it's seemingly like there's nobody that can lose at this point because you just put your money on anything and it just rides higher and higher. But that usually doesn't end well, at least in the longer term. I think that people are not, let's say, hedging their bets. They're not actually doing things as they should for a longer term scenario. And that's a problem. That is a problem. It always is this way late in the cycle. And we're seeing that pattern repeat today. This chart right here is showing you the 10-year bond yields. So you can see that Germany has the same situation happening with them because all of these different countries are experiencing this where this isn't something that, a trend that was declining for years and years, now reversing. Will it continue? That's the expectation. That's what I talked about with Bill Ackman. Others have said the same thing. There is much anticipation of higher inflation. So we'll see what the Federal Reserve and others do to try and push this back down. Yield curve control. Are they going to intervene more? I talked about what the Reserve Bank of Australia is doing. They want to pump more money in. The ECB wants to do a similar action. We'll see what happens as a result of all of that. It seems like inflation is going to be the way that they want to get out of this mess and simply ruin the livelihoods of the average person. Really quickly want to get through a few charts here. Full-time employees relative to working age population. You see as it peaked out in around, let's say, the year 2000 at 54%. Today sitting at 47.92. That was rising for years, in fact, after the financial crisis. And we know why, that there's manipulation on the data that I've talked about in previous videos. But regardless, this is down significantly from its peak. And this just shows you that things have really, really changed over this long-term period. And nobody wants to talk about that. But of course, this is the reality. You cannot look at the U3 unemployment rate to understand what's happening with employment. Labor force participation rate, you see again that over the last few years, let's say throughout this period here, hard to tell, but let's say 2014, 2015, this was picking up and it was starting to increase. And then we encountered these problems, of course, from 2020 and on, and it's down significantly. It is at 61.4, a level it has not been at since the 1970s. Things have changed in the economy, and the expectation is simply that as long as the government fills in the gap, everything's going to be okay. This is just showing you the inflation-adjusted market cap over the GDP, and that's just something that is very important, I think, to look at over time to give us an idea of what's been happening in relation, not necessarily in dollar value, in a price. We're looking at this in relation to the GDP so that it shows you the economy versus the stock market. And of course, the market, in this case, the S&P 500, the gray shaded area, has been growing tremendously, but it gives you an idea of how much further the growth of debt and the growth of the balance sheets and so on, which I think I have another chart on that. But comparing the two is just unbelievable because the GDP growth has not been there at all. These are some more charts right here just to compare. The bottom right corner, you see the growth of stocks versus the Fed. Fed's balance sheet has grown. I mean, you see how far the stock market has gone, but compared to the Fed's balance sheet, it really is nothing. So there's a few more charts here if you want to check those out as well. The GDP compared with the stock market compared with the Federal Reserve. It just gives you some insight. For everyone that stayed to this part in the video, you're going to get what's really interconnected with what I talked about at the beginning. So this is the Federal District Court declaring the CDC eviction order unconstitutional. So we'll see where this goes from this point, but understand what this means. You have these eviction moratoriums that are in place today preventing the landlords from booting out their tenants if they haven't been paying up. So this right here would, of course, be massive if this goes widespread and we start to see more of this, because you're going to have individuals that end up on the streets, okay? Are they going to be able to get somebody? Is the landlord going to be able to get somebody in there? We'll see. That's another fact. But the point is you're going to have homelessness increase dramatically. I do think that what we're seeing today is simply delaying all of this process, because where is the money coming from for these people with their rent? Are they employed at this point here? What's going on with their financial situation? I mean, there's a lot of questions that we don't have answers to, but we know specifically that people who have not been paying their rent, those bills have been piling up, at least on the statistics, at least on the surveys that I've been showing you here. And that, of course, has to be really come up and show its rear its ugly head at some point. So we'll definitely see that. Definitely connecting in with all the other information, bankruptcies on the business side, the landlords, the lenders, all of this must come and must be showing itself at some point. I will keep you up to date on it, of course. I'm going to finish off the video with this one right here. You could see government transfer payments as a percentage of the total income. So understand, if you look around today, and this, by the way, goes back from 1959 up until the present, right now today, approximately 27% of the total income in the United States is government money. Government money. And that just gives you a look at where all of this so-called prosperity is coming from. It's coming from tax dollars. It's coming from the future. They're trying to pull the future into the present. And in doing so, of course, will ultimately destroy the currency itself. And they leave you with nothing but confetti. If you found the video informative, hit that thumbs up button. All you got to do to support me is click the one button. I appreciate that. If you want to learn about e-commerce, you can learn for free at my website, theamazongps.com. If you want to know about the financial system from top to bottom, A to Z, you can do so in my 2 books. Check them out at the link in the description. And if you want the audiobook, it's available at themoneygps.com. But wait a second, if you haven't seen this video, you absolutely want to check it out. Click it and I'll see you there.